There is a quiet misunderstanding about investment books that misleads almost every beginner. People believe the best investment books teach you what to buy. In reality, the books that endure, the ones financial celebrities return to decades later, teach you how to think when money, uncertainty, and human emotion collide. The value of these books is not information. Information expires. Their value lies in frameworks that survive cycles. Financial celebrities do not read investment books to feel smart. They read them to correct blind spots. Each book becomes a mirror, revealing how the reader misjudges risk, time, confidence, and fear. This is why the best investment books age so well. They are not about markets. They are about people inside markets. The earliest classics focus on discipline before intelligence. Long before algorithms and high-frequency trading, these books warned that the greatest enemy of returns was the investor's own behavior. They describe markets as voting machines in the short term and weighing machines in the long term, not as poetry, but as psychological reality. Financial celebrities absorbed this lesson deeply. It taught them patience in a world addicted to speed. Another group of books centers on valuation not as a formula, but as a mindset. They explain that price is what you pay, value is what you get, and the difference between the two is where all returns come from. But more importantly, they teach humility. Valuation is not certainty, it is probability. Financial celebrities learn that investing is not about being right, it is about being less wrong than others over time. Some of the most influential investment books are not strictly about investing at all. They explore human psychology, decision-making, and cognitive bias. These works reveal why intelligent people make catastrophic financial mistakes. Overconfidence, confirmation bias, loss aversion, narrative fallacy. Financial celebrities often cite these books as more important than any market manual because they explain why good strategies fail in practice. Then there are books about cycles, economic cycles, credit cycles, market cycles. These works dismantle the illusion of permanence. They show that no regime lasts forever. Cheap money creates excess. Excess creates fragility. Fragility invites correction. Financial celebrities who survive multiple crashes often credit these books with giving them pattern recognition, the ability to recognize danger not by price movement, but by behavior and leverage. Another category focuses on long-term ownership. These books emphasize businesses over trades, cash flow over excitement, endurance over timing. They teach that great investing looks boring from the outside. Financial celebrities who followed this path learned that compounding requires inactivity as much as action. Doing nothing, when done intentionally, became a competitive advantage. There are also books that demystify randomness. They explain that outcomes do not always reflect skill, and failure does not always reflect stupidity. These books are uncomfortable because they attack ego. Financial celebrities embrace them because they freed them from false confidence. Once luck is acknowledged, risk management improves dramatically. What separates the best investment books from the rest is their resistance to obsolescence. They do not promise secrets. They warn against them. They do not predict markets. They describe incentives. They do not glorify success. They analyze survival. Financial celebrities recognize this immediately. They read these books not once, but repeatedly at different stages of life because the meaning changes as experience grows. Another recurring theme across the best books is the importance of margin of safety, not just financially, but psychologically. Having room for error, avoiding ruin, preserving optionality. These ideas appear again and again because they work across every asset class and era. Financial celebrities internalize this so deeply that it shaped not only portfolios, but lifestyles. Some books emphasize the investor's relationship with time. Short-term volatility is framed as noise, long-term patience as strategy. These books teach that wealth is transferred from the impatient to the patient. Financial celebrities who embrace this lesson learn to endure boredom, criticism, and underperformance without abandoning principle. This endurance separated temporary winners from lasting ones. Importantly, the best investment books rarely agree with each other on tactics. Some favor value, others growth, some diversification, others concentration. But they agree profoundly on one thing. Investing is less about brilliance and more about temperament. Financial celebrities noticed this convergence. Strategy mattered, but temperament determined whether strategy survived stress. Another powerful insight from these books is that investing success is path dependent. A single catastrophic mistake can erase decades of discipline. Avoiding ruin matters more than maximizing upside. This is why many great investors appear conservative in public while being quietly aggressive, where risk is asymmetric. Books that highlight this truth often feel underwhelming until crisis arrives. The best investment books also teach skepticism toward authority. They encourage independent thought, second-level thinking, and the courage to disagree with consensus. Financial celebrities valued this deeply. In markets, comfort is expensive. Consensus often reflects safety, not truth. Books that train readers to question popular narratives build intellectual resilience. Over time, financial celebrities develop a personal canon, a small set of books they reread, quote, reflect on, not because the words change, but because they change. Early on, the books teach technique. Later, they teach restraint. Eventually, they teach wisdom, how little needs to be done to achieve enough. Another overlooked benefit of these books is emotional calibration. They normalize fear. They legitimize uncertainty. They explain that drawdowns are not failures, but tuition. Financial celebrities found comfort here, not comfort in losses, but comfort in understanding that pain is part of the process, not evidence of incompetence. What is striking is how often financial celebrities say the same thing when asked about their favorite investment books. They do not mention recent bestsellers, they mention decades-old texts. Books written before modern markets, yet still accurate in their diagnosis of human behavior. This longevity is the ultimate test, and this is where the story begins to narrow. Because once we stop asking which books will make us money and start asking which books will prevent us from losing ourselves under pressure, the definition of best changes entirely. The best investment books are not manuals. They are inoculations against bad decisions. They do not teach certainty. They teach survival. It is at this point where reading becomes less about knowledge and more about discipline that the true role of investment books is revealed, shaping not just portfolios, but the investor's relationship with risk, time, and self, unfolding gradually through rereading, reflection, and lived experience, like a compass that does not tell you where treasure is buried, but prevents you from walking confidently off a cliff. And this is where the role of the best investment books becomes unmistakable, not as shortcuts to profit, but as safeguards against self-inflicted damage. In the second half of the story, financial celebrities begin to describe reading not as consumption, but as conditioning. The books that matter most are the ones that quietly recalibrate behavior under stress. They do not excite, they steady. They do not promise advantage, they remove disadvantage. Over time, this distinction becomes decisive. One of the most powerful effects these books have is expectation management. They teach investors what normal feels like: long periods of underperformance, years of boredom, sudden drawdowns, missed opportunities. By normalizing these experiences, the books immunize readers against panic. Financial celebrities often say their greatest edge was not insight, but the ability to remain calm when outcomes temporarily contradicted effort. The right books made that calm feel earned rather than forced. Another transformation occurs in how readers relate to advice. Early on, books feel like instruction manuals. Later, they feel like conversations with mentors who are no longer alive but still present. Financial celebrities return to the same passages during different market regimes and find new meaning each time. What once sounded conservative becomes wise. What once sounded obvious becomes urgent. The book did not change, the reader did. The best investment books also refine the investor's relationship with mistakes. They remove shame, they replace it with curiosity. Losses become case studies rather than indictments. This shift is subtle but profound. Financial celebrities who learn to study their own errors without ego improve faster and suffered less. Books that frame mistakes as tuition rather than failure create investors who stay in the game long enough to benefit from compounding. Another essential contribution is boundary setting. These books clarify what not to do. Avoid leverage you cannot survive. Avoid narratives that require perfection. Avoid complexity you cannot explain. Financial celebrities valued these negative rules more than any list of opportunities. Knowing where not to step is often more valuable than knowing where to run. The books also cultivate a long memory. They remind readers that markets have been euphoric before, that crashes have happened before, that certainty has always been punished eventually. This historical grounding shrinks the emotional size of present events. Financial celebrities who read history felt less pressure to react to headlines because they recognized the pattern beneath the noise. Importantly, the best investment books do not make readers cynical, they make them selective. Optimism is preserved, but filtered. Hope remains, but disciplined. This balance allows investors to participate without surrendering judgment. Financial celebrities describe this as learning how to be optimistic without being naive, a rare and valuable posture. Another insight emerges around rereading. Financial celebrities do not read many books once. They read a few books many times. Repetition deepens understanding. Familiar sentences become triggers for restraint. In moments of temptation, a remembered paragraph can override impulse. The book becomes part of the decision-making system. As careers mature, reading also becomes quieter. There is less urgency to discover the next big idea, more desire to reinforce first principles. Financial celebrities gravitate toward books that remind them who they are at their best. Reading becomes less about growth and more about alignment. And then something unexpected happens. The investor realizes that the most influential books did not change what they bought, but changed when they did nothing. The restraint to sit out manias, the patience to wait for clarity, the courage to hold through discomfort. These moments, invisible on performance charts, account for a disproportionate share of long-term success. So the lesson resolves into a simple but demanding truth. The best investment books do not make you richer directly. They make you harder to break. They protect temperament, they stretch time horizons, they keep ego in check when markets invite excess, and fear in check when markets invite despair. If this reflection resonated with you, pause and ask yourself one question. Which book has most often stopped you from making a bad decision? That is likely your best investment book. Share that thought. And if you want to keep exploring how timeless ideas quietly outperform clever tactics, stay connected. Subscribe, follow, and return. Because in investing, the books that matter most are not the ones that promise the most, but the ones that keep you standing long enough for compounding to do its work.